I want to welcome everyone. Today, I'm Patrick Seaman. Today, we're going to be discussing what a structured note is and what it's not. These types of investments are complicated, but definitely worth learning about because they can potentially give your investments a great opportunity for growth, increased diversification. They may provide income and they may significantly reduce the risk in your portfolio. This webinar, I'm telling you what, it's going to be so exciting because we will share all of the fun disclaimers and disclosures, the pros, the cons, advantages and disadvantages, and kind of the yin as well as the yang. Basically enough to fill up the our beloved compliance encyclopedia. And we're going to do all this in about 20 minutes. And you're not going to want to miss this because planning for retirement shouldn't be a mystery and it should be simple. And that's what we're here for. Now, I'm here today with my guest, Dan Magnetta. He is the structured note guy, lives outside of Chicago and works for Barnabas Capital. Dan, I want to thank you so much for joining me today and welcome.
Pat, yeah, thank you for having me. I'm happy to be here. I'm very excited to get started.
So, Dan, being the structured note guy, I have to ask, do you have any type of superpowers?
I don't know about superpowers, but there definitely is a lot of maybe reading involved to make sure that we can help break down the components of structured notes so we can help serve advisors like yourselves and their clients and understand what's going on with the
So,
component pieces.
I think you would say you have a very large brain. But I also think that the structured note guy could kind of reassemble shredded documents or notes, like just in a flash, right?
Yeah, I would say that's actually a good point. Yeah, there is a lot of that goes on of going through some of these component pieces and helping break it down and reassembling them in a way that's easily
Yeah,
digestible.
exactly. Yeah. Well, first of all, I'd like to ask you, start off with a question, and just ask kind of who offers structured notes, where can you buy them?
Yeah, it's a fantastic question. So, maybe I'll start with Barnabas Capital. What we do at Barnabas Capital is we are a third-party distribution partner of the world's largest banks. So it's not Barnabas Capital that is issuing structured investments. We serve as experts and distribution partners for banks who are the issuers of structured notes and structured investments. And when we talk about the world's largest banks, we're talking about groups like JP Morgan, Goldman Sachs, Morgan Stanley, HSBC, Citibank, UBS, et cetera. They're the actual issuers of structured note product. They're the ones that put them together and make them available for investors. In terms of actually being able to access them, you do have to, at least here in the United States, be able to go through a financial advisor like yourself, which is a great thing, right? Because there are some moving pieces when it comes to various structured notes
I definitely
and
need to
payoff
really take
profiles.
the time to understand them and for our kind of our area of expertise, we're able to sit down with clients and really take the time to make sure they understand them, which is just so important.
Absolutely. Yeah, absolutely. I mean, one of the things about structured notes that can be challenging for folks that are new to the concept of structured notes and structured investing is that the payoff profiles are almost unlimited. So you really do want to make sure that you're taking time to sit down with somebody like yourself and your team who've really dived into this, become experts in this space to really understand where the risk lies in different strategies and where they may fit in a client's portfolio.
I want to kind of start off with something that's very complicated, and then maybe we can back down and make it a little bit easier. And I love this definition. I got this from Investopedia. It says, structured notes, it says they are considered a debt obligation that also contains an embedded derivative component
Yeah.
that adjusts the security's risk return profile. I mean, I kind of think that explains it all, and we could probably
Yeah.
end the webinar right now, right? But I
Uh,
do want to be thorough in case people didn't get that definition. And I'm wondering if you can explain that. Wait. Maybe you don't want to explain it. Maybe you could just tell us, what a structured note is.
Yeah, at the end of the day, what a structured note is, from an investor's perspective, it's a corporate bond, right? It is a senior unsecured debt obligation of the issuer. So earlier, I mentioned the banks that put these together. Let's pick on JP Morgan, right? When you're buying a structured note, what you're actually buying is a corporate bond from JP Morgan Chase, right? It's a senior unsecured debt obligation of that issuer. There are derivative components to it, but from the investor's perspective, they're buying that corporate bond. The bank is utilizing or potentially utilizing derivatives. They may be utilizing option strategies to actually deliver on the payoff profile that is promised in the bond, in the prospectus document for each individual bond position. But at the end of the day, what it is and what they're trying to get across in Investopedia is it's a debt obligation. It's a bond from one of the world's largest banks like JP Morgan.
Yeah, one of the things I like to describe it as, and this actually came from one of my clients of mine, so this is not my original idea, is they said it's like the bank's recipe for an investment. I know we said in our email when we were promoting this webinar, we said, is there a way to have your cake and eat it too? Well, I think the bank's recipe for a structured note cake, might allow you to do that, but you have to understand that the yeast might be bad and the cake may not rise. But I kind of want to ask, further, about what Investopedia says, which they go on to say that the return on a structured note is linked to the performance of an underlying asset or index. So an index would be something like the S&P 500, right? So if it goes up, would your investment go up? Maybe you could expound upon that and explain that a little bit more.
Yeah, absolutely. And Investopedia is doing a great job of explaining this. So if we think about what a structured note is, right? We just mentioned it's a corporate bond. And so for folks that are joining us today, you may be familiar with how a bond pays. Typically, it's periodic interest, right? So a typical bond is saying, hey, you're going to loan me money for a specific period of time. And in return, I'm going to pay you interest, right? I'm going to give you a coupon payment is the jargon that we use in financial services industry. In a structured note, what they're doing is rather than giving you a set interest rate, they're saying, we're going to give you a payoff profile that, if it's a growth-oriented structure, might look something like this. We're going to buy the S&P 500 for the next 5 years. We're going to give some type of downside protection, and we're going to have some type of upside participation on that. You could also do it in an income wrapper, where maybe instead of giving growth over the course of 5 and having a variable return profile, it could be a current income type strategy. But the big thing I think that they're getting across there on that definition is rather than having a set interest rate, they're giving you market linked performance. And here in the US, at least, a lot of typically what we're doing is buying exactly what you called out, what we call equity linked notes, where you're utilizing something like the S&P 500, or it might be the Russell 2000 that you're using to get performance, right? Whether it's growth or income with some type of protection on it.
So, the return is kind of based on the performance of some underlying index. If that index goes up, you get some type of return. If it goes down, you might have some type of protection. I always kind of think it like they have guardrails around that investment. If you're looking at it from our perspective, rather than the bank and using all the derivatives and all the stuff behind it. But, could they actually have 100% protection, total principal protection?
Yeah, absolutely. In fact, there are 2 different types of products that would fit in that bucket. There are principal protected notes, where you might be linked to some type of index where you're getting upside potential, but if that index is negative at maturity, the bank is offering to protect the principal. And then there are market linked CDs. And the reason I wanted to differentiate those 2 strategies is that while they both offer downside protection, we talked about structured notes being a corporate bond. And so in a fully principal protected product, like a principal protected note, it's principal protected as long as that issuer is in business to deliver on that principal protection, right? So we want to make sure that we're comfortable if we're buying a bond from JP Morgan Chase, that we are taking the credit risk of JP
And I think
Morgan.
that's one of the things I like when we look at these structured notes, and I look at a list of them every month, and they're from these really big banks like JP Morgan, Wells Fargo, and so forth. So there's a certain level of comfort I have in knowing that these are really big banks. They're too big to fail, right? I'm just kidding.
Yeah.
But I mean, that's the hope, But
Yeah.
but the CD kind of adds that extra layer of protection, just like a CD at any other bank. Is that if that something goes wrong with that bank, you have the FDIC coming in and protecting it up to 250,000.
Correct. Exactly. And there are multiple CD issuers, in the US in structured product plans. So even if you were looking to protect more than 250,000, just like you might with your bank account, right? You may go to multiple banks in order to try to enhance the level of FDIC insurance protection that you have. But I do think one of the things that you hit on with that I wanted to reemphasize, because I think it was important. You mentioned that you're really looking at this as buying guardrails, right? And I think that's a great way to describe this, because really, I think the way to break down what's happening in a structured investment is they're formulaic returns, right? When you're buying the structured investment, you're giving given those guardrails up front, right? And you can kind of break them down into if this happens, then this. We don't know what the underlying index is going to do unless we had a crystal ball, which if we did, we'd probably be on a beach somewhere, right? Enjoying our
Absolutely.
profits from a trading strategy we may have. But so while we don't know what the underlier is going to do, we know what those guardrails are up front, and we can say if this happens, then this.
So these notes are generally they have different terms or periods. Maybe you can talk a little bit about that. I know you mentioned 5 years before, but what do they generally range? What does that really mean?
Yeah, it's a great question. So all structured investments do have a time horizon associated with them. Typically, we see folks buying 1 to 5 year terms. So that could be anywhere from 12 months, might see it at 18 months, maybe 24 months, which would be a 2 year investment. They are designed as buy and hold strategies. So one of the things that advisors do for their clients is make sure if you're looking at a structured investment that the time horizon matches up with the client's goals and their needs. There is not an active secondary market for structured investments. Secondary market would be something like the stock exchange, right? If you're trading stock, you can go to the New York Stock Exchange and sell your stock to somebody else who's looking to buy it. With a structured note, there may be potential for liquidity, but usually you're selling it back to the issuing bank. And they're usually not under an obligation to buy those back. So that time horizon component really does come into importance for investors. If you're buying a 2 year long structured note, we encourage folks to make sure that they're matching that with their time horizon because they may
Yes.
not have liquidity along the way.
So you kind of want to go into them saying, hey, if I'm buying a 2 year note, I plan to hold it for that 2 years. Now, I personally have sold notes
Yeah,
midterm, and it was available. And for that particular client, it worked out really well. But we definitely went in. We didn't go in with that attitude saying, "Oh, we might want to sell this. We have to sell this in a year." Absolutely. I want to go back to something about the protection and some of the terms that the banks use to describe how they protect you, from loss. They
yeah,
use the term buffer and they use the term barrier. It
yeah.
seems like they've got their own language, but maybe you could kind of explain that. Like when we're talking about, let's say, a 2 year note and it's tied to the S&P 500, at the end of 2 years, and this is where this buffer really comes or barrier comes into place in that protection
Absolutely.
is at the end of that term, if you have a buffer or if you have a barrier, how does that actually protect you if that index is down at the end of 2 years?
Yeah, it's a phenomenal question, and I know it seems like there's a lot of jargon. I've been in the space for a long time now, and the good news for investors out there is the jargon is improving over time. It used to be a lot more confusing, so we'll get there. But with buffers, the way that type of protection works, the analogy that I like to use is an airbag, right? It's a type of hard protection. It is a protection that is in place out into the future, right? Almost like insurance, right? You're buying insurance on your home today in the event that something happens in the future. That is how a buffer is going to work. To your point, if it's a 2 year long note with a call it 10, 20% buffer at maturity, that full buffer style protection is going to come into play fully at maturity if the underlying index is negative. And why I call it an airbag and why I like that analogy is that it's designed to absorb losses, right? So in the event that the index is negative and maybe you see something out there with a 10% buffer on it, index that you're linked to is down 11%, the product would be down 1%, right? And that's where that airbag effect comes in. It's like a cushion, right? In the event that you have a deep drawdown of 10 or 20%, whatever the buffer amount on the product is. A barrier is different. Barrier style product, you may hear the jargon out there, read in a prospectus document, soft protection. It's a type of protection that is in place unless you go through it. And so a lot of times we hear advisors, and I know you have a great analogy for this, so you may share yours, but you may look at that type of protection as a glass floor, right? So in the event that you have a barrier style protection, it is in place if the index is down unless you go through it and the glass breaks. And then you end up taking on the full loss. Why would folks consider two different types of protection is kind of the natural next question that comes up there. Buffer style protection is more conservative, right? Barrier style protection, maybe for a more aggressive client, because you could end up taking on the full loss of that underlier in a down market, but it also tends to give you higher upside potential, all else being equal in the product than buffer style protection that's got that hard coded protection in place with that airbag.
So I know I'm not supposed to use examples for compliance purposes, but I'm trying to, trying to make sure we get our head wrapped around this. A buffer would be if you have a 2-year note and you put $10,000 into this note. At the end of 2 years, let's say the underlying index, like the S&P 500, is down 20%, and let's say you have a 20% buffer, then hypothetically you would be protected for that first 20%, which means at the end of the 2 years you go, oh my gosh, the S&P's down, but I didn't lose anything. I got my $10,000 back, right?
That's
But
right.
let's say with the buffer, instead, the index went down 25% and you had a 20% buffer. You're protected for that first 20%, but you still would lose 5%. So you lose $500 on a $10,000 investment. But the good thing is you didn't lose $2,500 on that $10,000 investment,
Exactly.
right?
Correct.
Versus
Correct.
a barrier, if you had, let's say, I don't know, like a 30% barrier, then if the index is down 29% at the end of that 2 years, and you put 10,000 in it, you get your $10,000 back. But if that index is down 31%, goes beyond that barrier, you'd lose 31%.
Correct.
So you'd have $6,900 out of your $10,000 investment.
Yeah, exactly. And so I think, one of the ways that we can, we started kind of with fully principal protected products that you can lay these out in a spectrum of offering full protection. The buffer would probably fall into a bucket of partial protection in your example. And then you've got barrier style products, which we'd probably classify as principal at risk, right? Like we hope that our protection is in place, but in the event of a really deep drawdown below our barrier, our principal is fully at risk.
So, the advantages are basically, with structured notes, they can offer an opportunity for growth. They can limit your losses in part, or they can be 100% protected, even FDIC protected if they're a CD. This is the yin. So then what are some of the risks or disadvantages of structured notes at yang?
Yeah, and I think this is very important. So we've touched on one earlier, right? The where I like to start when I'm talking with advisors, at least, educating them on this product line is making sure that we do understand that we are buying a bond from an issuer, right? So credit risk is a big component. If we like the payoff profile of the note, that's great. But as we touched on earlier, we want to make sure that it could be the greatest payoff profile in the world, but if it's a bank that is not in business to deliver on that payoff profile and they default on that obligation, that's a problem for our investment. So that's kind of the number one place that I like to get folks started is making sure that we're comfortable with the issuing bank as we are buying bonds from that bank. The other
I'm going
component
to
to this,
say
though,
just to
yeah,
interrupt. I know one of the ways we try to minimize that risk is by buying from several different banks. So we don't put all your eggs in one basket. There's going to be there at least, in the typical portfolio that we would have, we might see 3 or 4 different banks.
that's great. Yeah, that's
Yeah.
phenomenal. I'm glad to hear that as a partner of yours because I think that's a great strategy to offer diversification. Just like you'd do that if you're building a bond portfolio as well, right? You wouldn't put all of your eggs in one basket, the traditional bond portfolio. Um, the other component then, once we start to think about what some of the yang to the yin is we are giving up potential upside. And the way that I like to talk about that is the cost of downside protection, right? And so sometimes what we may see is a product that offers full principal protection linked to an equity index may have a cap on it where we have a maximum return over our set period of time. And the reason that cap is in place is literally it's the cost of offering that downside protection. It's very difficult to have a free lunch in investing where you get full downside protection and full upside potential. And so in some structured notes where that comes in is a maximum return. And in the event that the underlying index is above that cap level, we are giving up that upside. We're not going to capture the full upside of that index. You
Right.
can see that in income notes as well. Income notes are designed as generating current income for investors, but there is no growth component to it. So even though income notes are often linked to equity indexes here in the United States, they're not designed to capture the growth of that index. They're designed to trade off that upside potential to turn it into hopefully high levels of current income for investors. And I think that's one of the areas to really make sure investors understand is that there is no free lunch, right? There is a cost here.
Absolutely.
And it can come in the form of upside potential to buy downside protection.
Other things I've noted were, and you mentioned before, is kind of illiquidity. I don't know if you used that word, but certainly if it's a 2-year term or if it's a 5-year
Yep.
term, you're going to want to hold that for that term. I'm trying to think if there's anything else that we wanted to mention. I guess the risk of loss would be the other thing, kind of like a stock market risk where the
That's
index
right.
is down and you do lose because the buffer's only 10% or 20%
That's
and the
right.
market goes down 30%.
Yeah,
So,
absolutely. So, you do have to balance a lot of that, right? Because you are still, if we're talking about the S&P 500, we're going through a little bit of this right now, where we might see a tweet or something that's moving the markets, right? That's headline risk, that's causing markets to move. Our underlying index in a structured note is going to move as well. So while we have protection in place, really, especially when it comes to buffered notes and barrier style notes, I think the idea behind that is to just try to tilt the odds of success in an investor's favor, right? We do still have principal at risk, different levels of downside risk, but the goal is to tilt the odds of success in an investor's favor, typically when we're looking at how U.S. investors utilize structured notes.
kind of a general question. Is there anything that we've missed?
That's a great question. And it's a broad question. I mean, I think that we're covering a lot of the important bases when it comes to demystifying some of the jargon that you see. One thing we did not talk about is participation rates that investors might see on the underlying index. And that is one that can seem intimidating for investors when they're venturing into structured investments land. But when you break it down into what a participation rate actually is, it is not that complicated. So usually in a growth-oriented type structures where the participation rate comes in, and we've been talking about equity indexes. So hypothetically, it's the S&P 500, right, that your performance is based on. If you see a participation rate listed at 100%, what that means is you're going to do 1 times the performance of the index, right? And so, if the index is positive 5%, a participation rate of 100 would mean that the structured product would be up 5% as well.
Okay. Well, anyway, structured note offerings, we get them. I just want to let people know how it works with us. We get a list of these different offerings at the beginning of every month from several different banks. I probably have about 50 or 60 pages just listing all of the different structured notes. And I get about a 20 or 30-day window to basically say I have an indication of interest that I want to buy one of these for a client. But if you would like to learn more about what is specifically available, and I think this really helps when you just sit down and go through these to be able to understand them. We would be happy to do that. You can give us a call. But I want to thank Dan for taking the time today. If anyone has any questions or would like again to set up a time to meet, contact our office or email me. We hope this webinar was helpful. And again, we thank you, Dan, so much for joining us and taking the time to explain all of this very fun, complicated stuff. Thank you very much, everybody. Talk to you soon.